So what is the sequence of returns risk? Do I need to worry about it? Does it affect me and my retirement? Well, I'll be answering these questions and a way to tackle and potentially negate this risk at the end of the video. Stay tuned. Aloha everyone, my name is Matt Ragudo. I am a chartered retirement planning counselor and I help individuals navigate their financial future. And if it's the first time you're visiting my channel today, welcome and consider subscribing for more retirement planning topics like this one. Alright, so what does a sequence of returns risk mean? And why haven't I heard about this before? Well, when you're accumulating money, when you are saving for retirement, the sequence of returns risk is negated primarily because you're in the market and you're not taking any money out. Once you start taking money out of the market, the sequence of returns risk becomes very, very apparent. And if you were to go ahead and click in the links down below, I have an image on what the sequence of returns risk means for someone if they have bad years when they begin their retirement. So think about it this way. So I'm going to cut in here. The sequence of returns risk is really hard to conceptualize. And when I watched this video after editing it, we need numbers. Well, at least most of my test audience needs numbers. So here we go. Let's take a look what sequence of returns risk looks like when we have the numbers. All right, here we go. Sequence of returns risk, a practical approach, which is what I like. So let's take a look at this first scenario. And this first scenario shows that both the investors initially invest $100,000. And after a sequence of returns of about 15 years here, you will see that they end up with the same amount of money. The returns were flipped, so that's all that changed. Their average annual rate of return was the same, average of 6.09%, and their ending balance, as you can see, was the same. And the sequence of returns had no effect on their investment. Now let's take a look at what the sequence of returns looks like if we have a different scenario on the money. So in this scenario, both investors initially invest $5,000 and then in addition put in additional $5,000 per year. And you can see in this case, the sequence of returns did make a huge difference, almost twice the amount of, investment results on this investor A versus investor B. And you can see that it's because of the sequence of returns. The returns were just flipped, just like in the previous one, but you can see it is a pretty large difference. Now let's take a look at the next situation. This is a situation most retirees run into because this is what happens. They have $100,000 and they want to draw income off of it. You can see my 4% rule video where I kind of talk about this theory where 4% was the old safe rate of withdrawing money. Not so much so anymore, but you can check the video. So as you can see here, the investor who experienced good rates of return in their first few years of retirement, they ended up with a lot more. Now this investor is taking out $5,000 a year. So this is a 5% more aggressive withdrawal rate, and this is based off of the S&P, so it's a way more aggressive investment portfolio. But you can see after 15 years, the huge difference here. This investor B actually has almost 3 times the amount of money left as investor A, and the only difference is that the return sequence or the sequence of returns was different. So what does that tell us? Well, what we can extrapolate from this is the negative years really do have an impact. And on top of that, the rate of the return doesn't really have that much to say when we are putting in money or taking out money. So go ahead and take what you can from this, and let's get back into the video. So what are some key takeaways that I myself take from these charts? And I'm a data freak. I love to look at the numbers. I love to play with numbers and figure out what creates better scenarios, and then of course have to take it back into the practical approach, because in the end these numbers fulfill one thing. They fulfill our need to have savings, our need to put savings in a place that best benefits us in our current situation and our future, how we want to live our future. Really, that's what these numbers are pointing to. They're not pointing to like, wow, look at A and look at B. They're different. What can we take away from that? Well, then, No. These numbers are to fit our needs and our lifestyles. So let's take a look at what are the key points that I took away from this. All right, so in this one, the sequence of return risk is not there. No matter which way you look at it, you end up with the same amount of money, and you also end up with the same average annual rate of return. So if you were to invest $100,000, the sequence of returns risk really doesn't matter to you. Now let's take a look at the next one. So the second set of circumstances, if you are contributing money, the key takeaway here is that you really should consider looking at, I don't want to say it, but timing the market, having some money on the sidelines and buying when the market is down. That might be a good strategy when you're looking at this slide to, key takeaways. The average rate of return is the same, but the account balances are far different. I don't know if any of you folks caught it, but these people both put in a total of $80,000. First they put in $5,000, and every year end after that they put in another $5,000. So $80,000 in all. And if you take a look at this investor B here, even though the annual average rate of return was 6.09, he actually only made about 3.3%. So I'll go into another video of how this actually happens, but for sequence of returns risk, you can see that it does have a very apparent risk at all. When you think of average annual rate of return, you think that, oh wow, that's what we're getting. That's what we all spew. This is the average annual rate of return for these stock or this mutual fund, but we don't really take into consideration the year end or the actual end-all be-all cash that we have left over. Now the key takeaway for the last slide, and this is a slide that many of our retirees are looking at, because this is pretty much their circumstance. And you can see 5 years, this person took out $75,000. They still got, not bad. We still have $41,000 in there. We took out $75,000. We at least didn't lose any money yet. But take a look at investor B. Not only did he take out $75,000, but he has more money now than he put in. So what does this mean? Well, basically it means that on the down years, if you want to play it safe, you don't take out any money. On the up years, you take out some of the money. And it becomes more of a flexible retirement plan than a real 4% or 5% in this case annual draw. So what can someone do to minimize or eliminate the sequence of returns risk? And there are a couple options for you. You can purchase what's called an immediate annuity. What that does is it gives you a stream of definite income for the rest of your life in exchange for whatever cash you give the insurance company at that time. And what that will do for you is take out market risk entirely. You will have other risks to manage, but at least the sequence of returns risk won't be there. The next thing you can do is construct what we call bond ladders. And bond ladders is a sequence of bonds set to mature at a certain time within a target interest rate in order to give you a better return. And I'll be honest with you, you can check out my video on safe withdrawal rates where I go over what the current interest rates are for these things and the current interest rates for the immediate annuities. But for the most part, those are the two only ways you can really eliminate the sequence of returns risk. Another strategy to kind of work within the sequence of returns risk is to do what I said a little earlier, and that is to utilize a smart approach to drawing down your assets, meaning when the market goes down, we cut some of our expenditures. When the market is up, maybe we go on a vacation. But that is going to be for another video when it comes to planning. All right, so I hope that helped you with some questions on the sequence of returns risk. It is a very in-depth, kind of more data-driven topic, but it is very important, as you can see from the numbers. So I hope we can dive deeper, maybe go further in these topics in a later video. But please check out my podcast, subscribe to my channel for more retirement planning topics like this one. Now on the screen, you can check on the Medicare topics I have. Annual enrollment is coming up. It is October 15th to December 7th. Or you can go check on more videos about retirement planning topics like this one. All right, have a magical day, and I'll see you in the next one.